Welcome to Embargoed, intelligent talk about sanctions, export controls, and all things international trade for trade nerds and normal human beings alike. I'm the host, Tim O'Toole, and with me today, we're going to do something new, and we're going to have a number of guests. I think this might be the most number of guests we've had on Embargo, but we're very happy to have them. Let me start with Eric Orsini, who is at Lloyd's Intelligence and is an expert on global trade, and then Laura Deegan and Manny Levitt, who work with me at Miller and Chevalier and are kind of the keys to our trade group, or at least some of the keys to our trade group, who have been on the podcast before. So everybody, welcome.
Thanks for having us.
Excellent. So why don't we get started? But before we do, I think we're gonna go with a segment that we're gonna call "Where in the World." And so, where in the world is Laura Deegan going to be over the next coming weeks? And then, Eric, if you have anything to add in, I'll invite you and Manny to jump in, and then I'll talk a little bit about where I'm going to be speaking as well. So go ahead, Laura.
So next week, I'm actually going to be traveling to Montreal for a very timely conference. And I say timely because it relates to the topic that we're going to speak about today. And the conference I'm going to is called Shaping the Future of Shipping, and it's put on by the International Chamber of Shipping. And I'm going to be helping to lead discussions on kind of external risks to shipping supply chains, one of them being sanctions. So if you are a listener to our podcast and you're attending by some chance that conference, I'll be at the pre-reception events. Please feel free to come by and say hi.
Excellent. Eric or Manny, anything to add?
So I'm going to be traveling back to Asia end of July, beginning of August. We're going to be hosting two events, Lloyd's Intelligence events, one in Seoul, South Korea, one in Japan, where we're going to be talking about just sanctions from a maritime perspective, conducting due diligence, the price cap, some of the things we're going to touch on today. So if there's any listeners in the Asia Pacific region, looking forward to seeing you guys there.
Excellent. We'll hope to hear more about that as it approaches. Manny, anything to add?
Nothing to report. I'll be holding down the fort in Washington, D.C.
Yeah, somebody's got to do the work, and I guess it's going to actually be left to Manny because I'll be in Denver the week of June 20th. I think June 17th to 20th at the Export Compliance Training Institute, where I teach from time to time, talking about the EAR and the ITAR. It's a 4-day intensive course, 2 days of the EAR, 2 days of the ITAR, and it'll just be me and one other person teaching that, and we'll have fun. And if you're there, come up and say hi, and hope you're listening to the podcast. So with that, why don't we turn to our big topic for today? Today is going to be a discussion of maritime issues, which it sounds like is pretty timely because that's what both Laura and Eric are going to be talking about pretty soon all over the world. So Laura, why don't you lead off with a little discussion about the price cap? Because when we're talking about maritime and sanctions, I think the price cap is the first thing that comes to mind. So tell us about the price cap on Russian oil and where it came from and kind of what we need to know about it.
Yep, sure. I mean, and we wanted to give this overview because we understand, we have listeners who are in all different kinds of institutions and come from all different walks of life. So just to give a general primer on what the price cap really is, it's a really unique type of prohibition or sanctions related framework that Treasury through OFAC came out with at the end of December in 2022, which feels like a lifetime ago from this point, but it's a good inflection point now that we're, coming up towards nearly a 2-year anniversary of the price cap. But essentially in December 2022, Treasury put out a determination related to a prohibition on certain maritime services if crude oil products, Russian origin crude oil products, were purchased above the cap. So if products from Russia, crude oil products, were purchased above the cap, then you couldn't use U.S. origin, certain U.S. service providers, mainly in relation to trading of the product, shipping of the product, insurance related to the product, certain financial services, so thinking about letters of credit and things like that in relation to the purchase of that product. And then in February of 2023, Treasury came out with a similar determination for petroleum products, and it set the cap for these products. So for crude oil, you're looking at $60 is the current cap, and then for petroleum products, it depends on the type of petroleum product. Discount to crude petroleum, you're looking at $45 a barrel. Premium to crude, you're looking at $100 a barrel currently, and those haven't changed significantly in the past, year and a half. And so, essentially, what the price cap does is it sort of creates an authorization for these U.S. service providers to engage in services related to the maritime transport of these products, so long as the product was purchased at or below these caps. If it's purchased above, then it's entirely prohibited. And the U.S. instituted this price cap policy along with the G7, so it's not just U.S. service providers that can't be used to support maritime transport. It's also other European countries as well. And the aim of this very unique price cap prohibition was really to limit the revenue that the Russian government could receive for the sale of one of its most valuable assets, which is, obviously oil products, but also ensure that the global energy markets were not roiled too much, that there wasn't causing this great effect on the oil markets that would unduly and negatively affect particularly U.S. consumers when you go, for instance, to the gas pump. So that's just a general overview of the price cap. I mean, there are obviously a lot of nuances to it in guidance and things like that, but I think we're going to focus more on really how we've seen the price cap affect shipping and, the global commodity market more generally.
No, that's great. And we've talked, in some detail, at least when the price caps came out on the podcast, about, some of the nuance. But I think, to just kind of boil it down, it sounds to me like it's new in the sense that we've seen sanctions against oil-producing countries in the past, right? Iran, Venezuela, but those are prohibitions. And Venezuela didn't start out that way. Iran's so old, I don't remember how it started out. But basically, you have a prohibition against either in Venezuela, you've got the state-owned oil company that gets put on the SDN list and some sanctions for operating in the industry. And in Iran, you just have an outright prohibition, massive secondary sanctions. The price cap, I think, was designed to be nuanced in the sense that there's not a prohibition on Russian oil. It's just trying to limit the flow of funds to the Russian government. So you have this cap. But the targets also are, to me anyway, interesting because you've got insurance, right? And so because and I think getting the Brits on board was really key to this because there's a huge insurance industry in maritime insurance industry in London, and then shipping companies. So, when you have the G7 on board and the US on board, the shipping companies and the insurance companies may have a lot more interest and ability to comply with sanctions regulations than, say, just the oil traders and the Russians, which are obviously, the Russian sellers and the oil trader buyers at the first instance may not be as interested in compliance. But as you get further down the chain, you've got more interest in compliance. So that's kind of the background. So how is it working, I guess, is the first question. We're what, a year and a half into the price caps being put into place or fully implemented. What are we seeing?
And maybe, Eric, this would be a really good opportunity to hear your perspectives, given your focus on the industry and, your sort of vast expertise.
Sure. So thanks for the question. I think generally the price cap has been working, right? So when looking at the goal of the price cap, reducing revenue, I think we're there. But I think there has been certain instances of the price cap that has had some unintended consequences. And when speaking about unintended consequences, we can't talk about those without talking about the dark fleet. And the dark fleet is a fleet of tankers, vessels, ocean-going vessels that move illicit product. So Lloyd's Intelligence, from our principal analyst, Michelle Bachman, has put together a methodology to capture the dark fleet. And I just want to define the dark fleet for the listeners and for those who have not heard of it. And the dark fleet is comprised of tankers that are aged 15 years or older. Reason being, they're less expensive to acquire and cheaper to maintain, or just lack maintenance at all. They have ownership that is anonymous, or that's designed to obfuscate the ultimate beneficial owner, or UBO. They're engaged in one or more of the deceptive shipping practices that were outlined in the May 2020 guidance. Those are loitering or uneconomical behavior, engaging in ship-to-ship transfers, and that is when two boats go in the middle of the ocean or offshore and transfer cargo amongst each other. They could be turning off their AIS transponder. And the AIS on a vessel is very similar to GPS in a car. It tracks the boat, or it tracks the boat. And now a little bit more nefarious is, instead of just turning off their transponders, they're doing something called spoofing. So they're pretending to be in one location when actually being in another. And the dark fleet now, it started back helping Venezuela and Iran illicitly trade their product. And then from May 2020, the Russia invasion, we saw the dark fleet increase exponentially. And today, as of I think May 2024, there's approximately 600 vessels that make up the dark fleet. And to put that into context, that's almost 15% of gross tons of the tonnage on the water. 15% of the international trading fleet. So the scope of the problem is quite large. And half of them, so 50% of these tankers, are exclusively trading in Russia. So unintended consequence of the sanctions is we're seeing a bifurcation, if you will, in global trade, because you have 600 tankers that are exclusively trading an illicit product. And now what we're seeing is that 82% of them do not have known P&I coverage. And when you think about that, you have 15-year-old tankers not properly maintained. Now we don't know who their P&I coverage is. This is a huge concern, because it's becoming it's not an if, but a when. From an environmental perspective, if something was to happen, who's going to cover it? So that's the start.
That's really helpful. And I think in terms of the dark fleet, it's a really helpful context to know kind of what is out there trying to essentially bust the price cap, right? Because presumably the traders and the folks who are shipping through the dark fleet aren't complying heavily with the price cap regulations. They're probably not getting the sort of attestations that are required. And I guess, so that's kind of how the price cap might be undermined. In terms of achievement of goals, Laura, I mean, on the one hand, and Eric, I think you're right, the price cap is working, but we may want to talk a little bit about what working means, because I think there was this perception at the beginning of the Ukraine invasion that the U.S. was going to impose sanctions on Russia, and those sanctions were going to be like this solid wall that was going to stop the Russian tanks at the Ukraine border, and sanctions were going to win the war, and there was going to be no cost otherwise. And obviously that didn't happen and was never designed to happen. So when we talk about the price cap working, certainly it's not stopping sales of Russian oil at above the price cap with 100% efficacy. And I think, Eric, your point about the existence of the dark fleet, makes that point perfectly. But what is working, and Laura, why don't you talk a little bit about what we think OFAC had in mind when it went into this? And I'm guessing it wasn't 100% success.
Yeah, I mean, and I think, to take a step back, you have to remember with all different sanctions regimes, the goal is not necessarily that you put out sanctions prohibitions and you expect that they will immediately stop activity that they're intended to stop. Sanctions take time to work. The effect of sanctions takes time to work. So when you see reports in the media that, you still have companies, let's say in different, countries, such as India or the UAE, still purchasing oil over the price cap, well, yes, that is to be expected. What the price cap somewhat achieves in some sense is scaring entities in some of these countries who are still buying from Russia and making them think twice about, do you want to continue to receive support from U.S. entities, or do you want to play with Russia? And the price cap partially is made to force those types of choices. And eventually, I think, and again, because it's a regime that still allows Russian oil to flow to the market, it's really making sure that Russia's revenue is minimized from its own sale. It's not meant to completely stop the flow. And again, that's not the purpose, because that might have very unintended effects on global oil markets. But I think in some respect, we have seen a lot of companies, especially in third countries, who are a bit more cautious to deal in any product that might even potentially come from Russia, where they don't know it comes from Russia. And when you see that type of caution, you could say, well, this is somewhat working, because you're scaring enough third country actors that they're looking more and more to comply with U.S. sanctions, and perhaps less and less at doing business with Russian oil entities.
Right. And I think that, I think your short run versus long run point, Laura, is really important to keep in mind, because if the U.S. wanted to have, and if the allies wanted to have a more severe effect on sales of Russian oil, revenue from Russian oil, the Iran and Venezuela models are out there. And, when you particularly, I don't know that I've seen the Iran figures lately, but I have seen the Venezuela figures. And when you look at the effect of sanctions on the Venezuela economy, it was stark. It was a real downturn in the Venezuelan economy, because the U.S. sanctioned by prohibiting sales, at least with the U.S. nexus, of the biggest resource in Venezuela. Could have tried to do the same thing with Russia, and the effect would have been more, but I think that wasn't really the goal here, and I think that gets back to what the goal was. But so there's this nuanced attempt to diminish revenues. It's a long run game. It's not going to be a short run game. Obviously, when there are sanctions, and not everyone is trying to comply with them, because the Russians obviously aren't, and there are other countries that may not be, there are some downstream consequences. So, when you say to insurance companies, if you insure Russian oil, unless there is some sort of evidence of compliance with the price cap, a lot of Western insurance companies get out of the market. What are we seeing for, how does that, is that market gone? Are these ships sailing without insurance, or are there replacement types of insurance that are coming into play? And why don't I throw that question over to you, Eric? But, Manny, if you want to jump in on any of this at any time, feel free.
Yeah. So I can tell you from what we've seen, and the appetite for Western insurers to insure what we call, again, the dark fleet vessels who are moving a large amount of this illicit cargo is extremely low. And that's evidenced by the stat that, only 18% of the quote unquote dark fleet tankers have Western P&I coverage. And what we're seeing for the other 82% is that either this coverage is unknown, they don't have coverage, or it's with P&I coverage in China, in Russia, in Iran, with insurers that are not as well known or may not as be well capitalized, right? So that brings us back to the environmental piece of it all. So if they do have P&I coverage, but if it's not a well capitalized P&I insurer, then how good is the coverage? Is it as good? It's just as good as the paper, right? So it's not as effective.
Yeah, that's, that is one thing that is really important to keep in mind here, is that you've got this terrible combination kind of building up. You've got unknown and potentially ineffective insurers, and you've got a fleet that's running around the world that is not probably in the best shape from an environmental standpoint, and they're carrying a lot of oil. Accidents can happen, and I mean, have we considered what the possibilities would be? I mean, how does China respond to this? What is China's view?
Yeah, and I think that's a good point, Tim, because we've been hearing a lot more about either China buying up Russian oil, or, I think we've talked before about, does China fill some of the gaps in these service providers who are no longer servicing, obviously the dark fleet or Russian oil companies. So Manny, Eric, any thoughts there?
Yeah, I actually had a question, on this, just for Eric, just as a follow-up. You said that 18% of the dark fleet have Western P&I coverage. Do these P&I companies understand, know that they have dark fleet vessels? Where is the gap in that, and why, if this is something that's apparent to you, why is this not, it's still happening, Yeah,
it's a great question, Manny. So I think that this is what's going on here is that the insurance companies are getting attestations. They are getting the documentation that gives them safe harbor. So they are asking their clients for attestations, etc. They are getting the information. So because it is legally permissible, or it appears to be legally permissible, they're continuing to engage in that business, right? None of us on either side of the transaction really know how much they paid for it. So the insurance company is getting that safe harbor, and they're comfortable continuing that activity. I think that 18%, it's good to have IG coverage, because in the event something was to happen, they would be capitalized, right? So, but I think that could be the reason why we're still seeing 18% coverage from the international group.
And I will say, we've had questions come up, not necessarily with the dark fleet, but questions come up from companies that get attestations, and just getting an attestation is not necessarily enough. I mean, you can get an attestation, but if on its face, it's signed by Mickey Mouse or Donald Duck, right? It's not going to be a great attestation. And if it's inconsistent with, some pretty obvious facts, it's not going to be an attestation. I mean, Laura, why don't you talk a little bit about some of the issues with respect to the attestations I'm not trying to discourage the 18% who are insuring the dark fleet, but they may want to think that just having an attestation is maybe not full protection, or the sort of protection they think it is.
Yeah, sure. And for some of the benefit of our listeners, so the price cap does have this sort of safe harbor policy, which says that if a downstream service provider, such as an insurance company, gets an attestation from, the commodity trader, or, from its upstream third counterparty, and the attestation says the Russian origin product was purchased below the price cap, there's a safe harbor for that insurance company should it be found that the product was purchased above the price cap, such that the insurer might not be subject to a potential sanctions violation, since sanctions violations are under a strict liability regime. So it offers a bit of protection. But the issues that we've seen with clients in either giving these attestations or being on the receiving end of these attestations is really a lack of information, either sometimes to back up the attestation. So, when you're looking at invoices, the OFAC guidance states that there should be itemized invoices, so you can break down the price of the product versus the price of other services in relation to the product, such as transportation. Some of these attestations don't really delve much into those itemized costs, and that can be an issue where you have to keep going back and forth to try to get further information about the true cost of the product. You also have people in the chain who maybe don't know that information or don't want to go back and ask for it, which can also be sort of a red flag, right? If you're not providing the information, why are you refusing to provide it? Is there something that you are trying to hide? The other thing that some of the updated Treasury guidance suggests is that you really should be receiving the invoices directly. And, again, it's another issue of, continually going back to that upstream party to ask for that information, and how willing they are to sign off on the attestation, and then really who's signing the attestation. We've seen issues if you are an insurance company, are you getting it from a charter party? Are you getting it directly from the trading house? And the price cap policy guidance gives guidance on all of this, but really to protect yourself when you're thinking about it, you want to go back to the entity that's directly purchasing the oil. And that's not always possible if you're an insurance company or if you're a bank who's, let's say on the receiving end of a letter of credit or something like that. So I think we see a lot of issues in getting the information. And then even when you are trying to provide your own attestation, there's a lot of scrutiny on it. People don't like the way it's phrased or like the way it looks, who's signing off on it, etc. And then there's also an issue of, making sure that you're keeping these documents for, I think it's still a period of 5 years that downstream and upstream suppliers want to make sure you're keeping those invoices in case they're ever subject to some sort of OFAC investigation.
You did say, I saw you hesitate on 5 years, Laura, and I'm not sure we've had a podcast since the law changed, but the hesitation, I'm assuming, is because the statute of limitations on sanctions issues now is 10 years, and so for all IEPA violations, and so at some point we're expecting that record-keeping provisions might change to reflect the 10-year statute of limitations. So, Eric, I want to turn back to one of the points that you made, and a major point that you made about the dark fleet. I assume that when OFAC listens to this podcast, there are not going to be people at OFAC going, "Oh my gosh, we got to call this Eric Orsini guy because we've never heard of this dark fleet. Like, where is he getting this information? Because we really need some help to figure out how to combat this." I assume they're not hearing about it for the first time. What are some of the things that OFAC is doing, assuming it's aware of the dark fleet, to try and combat the fact that there is this dark fleet of ships that is out there that you're describing that is doing some oil trade that OFAC might not like?
Yeah, so over the past couple of years, we've seen OFAC come out with a number of advisories, not just OFAC, but the UK as well, talking about deceptive shipping practices and how to remain price cap compliant. So our regulators are trying their best to educate the industry and highlight where the risks are and the red flags within this activity. We've also seen enforcement. Hasn't been monetary penalties, but we've seen designations of vessels, of vessel owners, operators, managers, of traders in the UAE and Hong Kong that are facilitating this illicit trade. So I think we're going to continue to see that. In conversations with OFAC, we know this is something that they are closely looking at. They're continuing to evaluate. So I do anticipate seeing more designations as time goes on. And I would anticipate more guidance, although it's getting quite circular and repetitive.
Great. Were you going to say something, Manny?
Oh no, I'm just waiting for you.
Well, then I will come through and shift the discussion to China, because I know that we've talked about kind of the dark fleet. I know that we've talked about the price caps. I think it's really hard to have this conversation without talking about China, which is, one of the two biggest economies in the world, doesn't have its own source of oil, and so is looking to buy oil from wherever it can get it. And there's a lot of oil in Iran and a lot of oil in Russia. And so how are all of these sanctions and all of these topics that we've been discussing kind of playing out in the Chinese economy, Manny? And I'll throw the big question to you, and then we can break it down.
Yeah, sure. So I think as you kind of alluded to, whether when you talk about the price cap, it may not immediately come to mind of like China's role in this, but it is a massive global economy with a massive amount of demand for crude oil and other petroleum products. It also has a lot of entities and financial institutions or smaller refineries that aren't necessarily super connected to the U.S. financial system. And so when you look at the price cap and you look at the sanctions on Iran, including the secondary sanctions on Iran and the energy markets, you have to kind of ask yourself, well, where is all this oil going if that's either evading these prohibitions, and where are there this drive for consumption of Russian oil and Iranian oil? And I think it's hard to not mention China in that context. I think Russia right now is the top supplier. I read something recently, just surpassed Saudi Arabia as being the top supplier of crude oil to China now. And I think there's some organizations that put out figures about China's consumption of Iranian oil as well. And I think there's some figures that put out a massive percentage of Iranian oil is ultimately bought by either officially or unofficially by Chinese refineries. And so I think Eric was talking about the enforcement actions we've seen in the price cap context, and with respect to Iran. You see every once in a while and over the last few years, periodic announcements of designations for companies involved in trading in Iranian oil or buying it or shipping it. A lot of UAE companies made the list. A couple here and there, Hong Kong entities. We haven't really seen a ton of Chinese companies, including refineries, shippers, or connected financial institutions that enable these purchases or facilitate these purchases of Iranian oil. And I think when you compare that sort of lack of activity to the U.S. government's enforcement or implementation of restrictions with respect to export controls, foreign investment in the United States, the scrutiny of certain items that are imported into the United States from Russia under the Uyghur Forced Labor Prevention Act, it sort of stands out. I think the context it often comes up from clients. They sort of assume that China is this heavily sanctioned country, and there are a lot of restrictions, but we don't see that in the same level.
Let me stop you there. So if I'm understanding right, so China is a big purchaser of Iranian oil, which is heavily sanctioned, a big purchaser of Russian oil potentially over the price cap, which itself is prohibited. Maybe there is or isn't a U.S. nexus, but there are certainly secondary sanctions that would apply to any purchases of Iranian oil. And yet we're not seeing, in the second biggest economy in the world, the sort of sanctions that you would get with this sort of widespread disregard for U.S. sanctions. I mean, why is that? And I'm going to throw that to everybody, but we'll start with you, Manny, on that.
Yeah, I mean, I think there's ultimately you have to consider in part there's a sense that there are certain financial institutions in China that are heavily connected to the U.S. and it'd be extremely disruptive to a relationship that is pretty central to the global economy. And you can kind of tell OFAC is always considering the collateral harm to U.S. interests when they designate a major financial institution, particularly in a country like China, and the ripple effects that can have. I think, and I could, I'm open to people's thoughts on this. I think there's also just strategic thoughts about ramping up sanctions on a country like China. There's always a sense of, once you ramp up, you sort of lose your sort of leverage once going forward over that. I think there's also a very different, and I think those considerations play into OFAC decision making. And Laura, I open to your thoughts on this. It's very different than what you see in Congress, where it seems like every week there's some pronouncement demanding more sanctions, wondering why there aren't more sanctions being imposed on these Chinese companies, given what we sort of know is happening under the surface with the purchase of Iranian and Russian oil. But yeah, I mean, Laura, I'd love to hear kind of your thoughts, just how that dynamic that you see from your experience.
Yeah, I mean, I guess from my experience and something for everyone to think about is China a Russia? And I think, we plan in the future to do a whole podcast on China. But is Russia as connected to the global economy as China? And I think, arguably the answer is no. We still have a lot of trade with China. We still have a lot of important products coming in from China. China is still a trade partner, even though we see this sort of still ongoing tariff war that could change if we have another president in the White House next year. And so it makes it a lot more difficult actually to begin to sanction large Chinese conglomerates who own a lot of these companies. And when you sanction those conglomerates, obviously by operation of law, a lot of their subsidiaries are sanctioned as well. And so those considerations are thought about throughout Treasury. What happens when you cut off a large trading partner? And it's not just what happens to people in the US, but what happens to people in Europe. Because you have to think that OFAC is not just thinking about the effect of its sanctions on US persons, which is its main sort of mitigation goal, but it's also thinking about the effect of its sanctions on its allies and partners, such as in Europe, and which is why you see sometimes a lot of mitigation and general licenses that relate to not only U.S. persons, but transactions in U.S. dollars that perhaps our allied countries are engaging in. So that's one. China is so connected to the global market. The other thing that you touched on, Manny, that's really important is thinking about an escalation strategy. And right now with China, I think we are in a period of, a wait and see approach to some respect. Wait to see, does China escalate things with Taiwan? Does China continue to support Russia in its war against Ukraine? And what does that look like? And, would that change if even our own U.S. administration changed next year? And so I think the U.S. government always wants to keep in its back pocket additional restrictions, particularly sanctions restrictions, which relate to China. So you do see, some prohibitions, especially the outbound investment executive order, other prohibitions on investments in the United States and trade tariffs and things like that. But additional sanctions on large Chinese entities would, I think, be a big escalation for the U.S. government, and they need to be able to keep that likely in their back pocket should things go south even more with China.
Yeah, the other thing that I would argue is part of this is that anytime you have a sanctions program, there are often unintended consequences. I mean, we've seen it with Russia. I think that certainly the sanctions against Rusal, the consequences were not widely anticipated, at least the effect on the global economy. And there are other instances, in connection with even, the price caps where there have been some unintended consequences. Unintended consequences with countries like Iran or Venezuela or Russia are manageable, even though they can hurt the world economy. Having a big sanctions program against China where you have unintended consequences, I mean, it could cause a global economic shock, the type of which we've never seen. And I think when you add to that, and I've talked about this on the podcast before, I think Brian and I used to talk about it quite a bit. The U.S. financial system's ability to impose sanctions is going to reach a limit at some point because it is the dominant financial system in the world. But at some point, if you impose enough sanctions, there could be a part of the world that decides that they want to create a real competitive financial system to that. And China is probably the leading candidate to try and do that. So imposing a huge sanctions program against China, I mean, one of the potential unintended consequences is that the Chinese financial system it's really straddled to this point. It's been, tried to comply with sanctions to the extent that it can, although I think that a lot of people there is this dirty little secret that the Chinese financial system has kind of its own various, nooks and crannies where maybe there's not great compliance with U.S. sanctions, but overall, it's probably not wildly out of compliance. If China basically decided that there's no point in trying to play with the U.S. economy and trying to start its own rival financial system, that might be an unintended consequence that could have real problems for the U.S. financial system. I'm not saying that it would, but I've always thought at some point, our sanctions are built on, the strength, the dominance of the U.S. financial system, and that has proven true with respect to the countries that we've sanctioned. But if we were to take on China, I'd be a little bit worried.
Can I ask, and this is a question maybe directed towards Eric, especially, because we have sanctions on countries that are really the world's oil producers, so Venezuela and Iran, and now obviously we have, to some extent more limited sanctions on Russian oil. What would happen in the event that we were to escalate further sanctions on China, and now we're kind of like forcing all of these countries more than we already have to create a coalition with its own sort of world economy? What's your view on the China angle, especially with respect to the oil markets?
Yeah, well, I think we're starting to see, again, that global bifurcation of trade today, where there is more trade in the Chinese yuan than there has ever been between China and Russia. They are insulating themselves from jurisdiction, from U.S. jurisdiction or the West jurisdiction by conducting the trades the way that they are. Back to your question earlier, Manny, about P&I clubs and the growth of Chinese P&I clubs. the dark fleet in the next 2 to 3 years, 5 years, whatever that number is, might not be a dark fleet anymore, because now they might be flagged out of China with Chinese P&I coverage and operating fully lawfully within Chinese jurisdiction. So I think that definitely is a challenge. Also with China, I think another piece of this is the upcoming US election. So if there was any further pressure on China that caused any sort of US harm from the price of the dollar and price of gas, anything that could impact the election, that could be a reason why we're not seeing more aggressive sanctions on China as well. But I do think the fear of East versus West type of thing happening is a real fear, and then the effectiveness of U.S. sanctions will certainly diminish.
I feel like with all the considerations about strategy, and I think this is all very kind of helpful to keep in mind, and I think puts a lot of this in context for people who are maybe surprised to hear that the sanctions on China aren't as widespread and its use isn't as aggressive as you might assume. What I'm sort of watching going forward is all of this in the context of recent legislation, the major packages of sanctions legislation like the SHIP Act, the Iran-China Energy Sanctions Act, all of which are sort of seem to be Congress really pointing at this more and more, going, you need to keep track of this, look at this, and it's sanctioned it as necessary, and also financial institutions included in this as targets in this. And I think while I understand like all these strategic reasons not to be overly aggressive, I think it'll be interesting to watch how that status quo remains in the face of this sort of increased pressure to target this kind of conduct.
Yeah, I mean, I viewed the U.S. approach from the regulators currently as one where they're trying to have an outlet for all of this venting that comes from Congress and and the general public with respect to China, while at the same time not doing anything that is just disastrous. And so you have this focus on export controls, which are targeted, right? I mean, export controls by definition, it's stuff coming out of the US so we can control it. We don't have to figure out what's going on between, Germany and Iran, or figure out what's going on between China and Russia in order to have this policy. There's a little bit of it, but export controls are more targeted. And then CFIUS is even easier because it's money coming into the United States, which is a lot easier to regulate. Once you start imposing kind of massive sanctions against China, you create this regulatory burden that is well beyond anything we've gone to, but it'll be interesting to see if that happens. Eric, I did want to circle back to one point you made, and that was with respect to China and the dark fleet. I mean, my understanding is currently China is a little bit nervous about the dark fleet coming in anywhere near its waters because of the problem that you talked about before, which is they're not all that environmentally compliant and they don't have insurance, or at least not good insurance. And so can you talk a little bit more about that?
Yeah, sure. So I think it was late 2023, Bloomberg put out an article talking about how Chinese ports have increased their frequency of inspections on these types of tankers. And what we've also seen from that is the flows of oil or cargoes going into Chinese ports. What we've seen is that outside of Malaysia, Malacca Strait, it's a ship-to-ship transfer hotspot. It's also a spoofing hotspot. And what we're seeing is dark tankers, spoofing vessels come into the Malacca Strait, engaging in a ship-to-ship transfer with another vessel, or maybe even a floating storage tanker. And then new vessels or different vessels would come into the chain, pick up from the ship-to-ship transfer vessel or the floating storage tanker, and then take it onward to China. So it seems like China's appetite for taking in dark fleet tankers has decreased given the environmental concern, and to mitigate that, they're engaging in more ship-to-ship transfers to bring in the illicit cargo on, I guess, cleaner vessels, if you will.
And so do you think that, the comment before about Chinese P&I clubs taking over for the dark fleet, do you think that would be a push, sort of a governmental push by Putin to push China to, support and provide P&I coverage for these vessels? Is that how that would occur?
That's an interesting question. I wonder if it would be occurring at that higher level of government. I mean, Sure. The answer could be sure, right? Any help that Putin can get from China is going to be helpful in the long term. Russia has an insurance carrier there, Ingostrak, who is providing P&I coverage to some of the dark fleet tankers. And what's interesting about the Ingostrak contracts is that there's sanctions exclusion clauses that are in every single contract. So I just find that to be interesting. But yeah, listen, if China P&I clubs are able to come and provide that gap of coverage, 80% of coverage, that's going to help the dark fleet tankers, again, not be part of the dark fleet. It could solve the environmental concern. And now you could see these tankers engage in more than just what we the illicit trade in Iran, Venezuela, and Russia.
And again, something to consider once that, the price cap covers Russian origin oil. Once it's been substantially transformed, it can be sold at any price into any country, including the U.S. So you could certainly see a world where, these Chinese teapot refineries are doing just that, transforming product and then sending it onward, and they're getting their cut, and Russia's getting their cut. So it's interesting to see if we'll see more China involvement in accepting Russian oil, which I'm sure we will.
And Eric, I actually had a question for you as well, if I could just jump in. From your perspective, we talked about a lot of the some increasingly sophisticated schemes that companies use to evade sanctions, spoofing, AIS manipulation, all of which I think now is sort of OFAC seems to be aware of, given just the nature and what they've described in their alerts and sort of public feedback and guidance. How much have you seen the industry adopt measures that are meant to detect this? Like how early are we on, or how concerned are companies that are managing fleets or managing involved in trades maybe farther up the chain? How interested are we? Because I feel like we've seen more and more of this consistent reporting on this, but it's hard to tell how much this has really sunk in for people in the industry.
Yeah, so varying levels, right? So your large global financial institutions are going to be your early adopters and quicker to operationalize due diligence, onboard a maritime provider like Lloyd's Intelligence to conduct and identify this behavior. Other industry stakeholders are a little bit slower to adopt, but I would say that the regulatory pressure, regulatory expectation has been heightened. So the industry is starting to follow along. I'd say that there's more work to be done for sure. Everybody wants to reduce their compliance burden, their compliance costs. They want to create operational efficiencies. So in doing so, they are loath to take on more of a compliance burden. But the industry is definitely moving in that direction. I would say not as fast as we at Lloyd's Intelligence would like, but we're definitely seeing a move towards it.
And does that vary by region? I mean, are Singapore and these places where there are hubs, are they as up to speed as, say, the financial institutions in London and elsewhere that are front and center to this?
Yeah, so I would say your U.S. financial institutions, UK, EU, even in Singapore, Japan, and Korea are quite well adopted. Less so in Indonesia, Malaysia, India, in the developing areas. Even in the UAE, we have very large customers that are really in the weeds of conducting this due diligence, understanding vessel behavior. We have certain customers that are looking at their book of customers. Who's involved in the shipping industry? Are you an owner, operator, or manager? If so, they want to track their fleets. So they're doing ongoing monitoring of vessel fleets to make sure that they understand the behavior. Banks or hedge funds that are involved in ship finance or vessel finance, they're doing the exact same thing. They're tracking these vessels on an ongoing basis. Trade finance banks, those are your big ones, right? That have the large risk, especially if they're dealing in wet product. Those are your early adopters. I would say that the price cap has pushed insurance companies, shipping companies, commodities traders a little bit further along from where we were 2 years ago. So again, regulatory pressure and expectation has certainly helped move the needle here, but ways to go.
That's interesting. So some of those compliance considerations are things that have just kind of evolved as a result of these worries about the dark fleet. why don't we kind of as a last word just go around the table and talk about if you had to give people advice on how to comply with OFAC sanctions related to shipping and maritime in 30 seconds or less, what would you tell them? And I'll start with you, Eric, because this is a topic that I know you've been given a ton of thought to.
Sure. So I would say that it's really, really important to know your customer, know your customer's customer, understand your business, what types of products and services you're offering, how your customers are using them. Make sure that you have sufficient tools. There's free tools out there, right? All the way through premium services like Lloyd's List Intelligence to be able to identify where a vessel has been, right? Who owns it, who operates it, who manages it. And then the most important thing today is, are they engaging in any sort of behavioral risks, i.e. spoofing?
Perfect. Laura, I'm going to give the floor to you.
Well, I think Eric and I, coming from large global banks, shared the same view that knowing your customer, and now unfortunately knowing your customer's customer, knowing your counterparty is really important. But something I would also say is try to be forward-looking and looking at risk. When you are engaging in long-term agreements with counterparties, particularly counterparties in areas of the world where they might not follow U.S. sanctions, thinking about companies in the UAE, companies in China, companies in India. What does the risk of operating with those counterparties, even if they're not located in Russia, other sanctioned countries, look like? Who are their customers? And also, being prepared for potential changes in the law. A question that we often get asked is, what happens if sanctions ramp up on China? Well, be prepared that if you're doing business with a Chinese oil company, that you are looking into the risks of doing business with that oil company long term. And don't always assume that, just because they're not sanctioned today, they couldn't be sanctioned in 18 months from now. So always consider those future risks depending on, what's going on with U.S. elections, what's going on with elections in other countries, and really look into your counterparties aside from a screening perspective. What does public source say about them? Those are the types of sort of future-looking controls or risks that I would say clients should look to.
That's great. And you managed to sneak in a preview for in terms of future, one of our future podcasts where we are going to try and do a deep dive on some of the potential coming risks, potentially out of the election, potentially out of developments in terms of China. So Manny, last word. What do you tell your clients about how to comply with sanctions based on the discussion that we've had today?
Yeah, I think based on this discussion in the maritime space, it definitely behooves you to spend some time understanding red flags and what to look for. Obviously, know your customer. There's no replacement for that, and that concept has been around for a long time. I think the red flags in this space, first of all, I think it's kind of fascinating. I think AIS spoofing and all the schemes that are used to evade sanctions is just interesting. But I think understanding how sophisticated that could be also informs what kind of tools you might need to detect red flags or detect evasion. Simply, for example, in the context of AIS spoofing or manipulation, if you just have a vessel tracking tool that just shows you where something's going, you might think in the past life, you might think, well, that's sufficient to really identify what's going on. But if knowing that there's actually evasion that goes on, knowing that there are certain patterns to this in archetypes or typologies to these sorts of schemes, I think it's worth knowing that, because right now it's very clear that OFAC has gotten a lot more sophisticated on detecting this as well.
Well, that is a great last word, and we'll leave it there. So I want to thank Eric Orsini, who's the Global Head of Compliance and Regulatory Affairs at Lloyd's List Intelligence, for joining us, and also thank Laura Deegan and Manny Levitt, who are keeping the lights on at Miller & Chevalier, for joining us. And to all the listeners, thanks for listening, and stay sanctions-free.
Produced by Heartcast Media.